Hey everybody, Tom Gentile. Welcome to a special Optionetics webinar tonight. First, Happy New Year to all of you out there. I haven't spoken to several of you since last year. And even though last year might be just a few months ago, since our last Optionetics event, Happy New Year regardless. Tonight, we've got a fantastic presentation. We do this about once a year. It is earnings, and we're preparing ourselves for the earnings season. And although earnings have started already, we've got a lot more coming. And so my plan tonight is to talk about earnings. I want to show I want to show you what everybody else does, because and this is a perfect time to talk about this company, because we were on a webinar last night with a lot of our tools members, and we were talking about Netflix, and so I want to show you, really want to show you Netflix buying calls, buying puts, buying straddles ahead of earnings, doing what everyone else does. I want to show you what happened, because we were discussing this yesterday before the big move that, or the not so big move that happened today, and why a lot of people are crying their eyes out right now that got emotional and bought into this, whether they were bullish, bearish, or neutral. It's a lesson called Who Loses the Most, and how we want to show you how to not only avoid that, but actually thrive from it. So that's our plan. We are, like I said, we are ready to rock and roll. I want to talk about this disclaimer real quick. We put this on every single one of our webinars, and you can read it in its entirety on the recording, which will be sent out to you immediately after the live broadcast. All right. But basically, I want to mention that stock and options trading, as you know, has large potential rewards, but also large potential risk. I also want to mention that myself, Jay Harris, and everyone associated with Optionetics and Tom's Trading Room, we're here to show you how it is that we trade, as well as our guest trader for tonight, who is Mike Wade. We are not registered investment advisors. We do not give personal trading advice, and everything we're going to talk about tonight is in US dollars unless noted otherwise. All right, so once again, I want to welcome back our students. You know, we do the majority of our webinars that we do are webinars that are free to our Optionetics students. Optionetics, we do the lifetime reattendance online. However, some of you that are with us for the first time, we want to welcome you back. Here we are. You know, Platinum, if you remember, Platinum has been upgraded to tomsoptiontools.com. I'm going to be demonstrating a little bit of Tom's Option Tools tonight, very, very little bit, but I want to show you, you know, so much more that we do with Tom's Option Tools. But we also, for those of you that ask, we do advanced seminars. The majority of them are online. We call them Mastery Series classes, and that's premium education, which actually comes with proprietary scans. And so we've got a bunch of them to show you tonight. This is a once-a-year program. We'll talk a little bit more about the details later on in the broadcast, but I want to leave it there for right now. What we're going to do tonight is we're going to talk about what we call earnings essentials. All right, we got question. If you have questions, we'll answer as many as we can right here tonight. Recordings will be mailed. Is going to be made available and emailed out to you following the event, and any handouts will also be emailed to you. You guys all know why we trade options. I mean, at least I hope you do. We do it for control, to control a large block of stock for a much smaller price. I like to call it rent control. All right, so we're renting the stock for a small period of time. There's protection that's involved in certain strategies where we can protect a stock or a portfolio. And then there's ways of paying for protection, and that's offsetting options such as spreads. Tonight, however, we're going to stick with control and protection, and I'll talk a little bit more about that because of the nature of the strategy that we're doing. The types of options we're going to be using tonight are calls, puts, and the combination, which is called straddles. We'll be talking about the buy side, buying calls if we're bullish, buying puts if we're bearish, buying straddles if we are neutral. So that is the plan. Now, I'm going to show you an example of a call, a put, and a straddle using a particular stock, Netflix, which was probably the most popular talked about stock yesterday and today. So I want to do this in a segment I call what most traders do around earnings. All right, so to do that, I need to get to Tom's Option Tools. And for those of you that have never used this before, if you simply go to tomsoptiontools.com, all right, here's where your username and password go. There's subscriptions. You can get to the subscription page to subscribe. But once you log in, we have certain different levels of our tools. They go from just the option trader. We have our contrarian trader piece, which comes with Darknet. We have a complete trader, which actually has money patterns that are based on time. And then, of course, our premium and masters area, which we're actually going to show you a little bit about this tonight. All right. Now, what I'm going to be doing is I'm going to be in the option trader area here for the next few minutes. All right. So let's take a look at Netflix. So this is Tesla Motors, but if we go into NFLX, I want to show you Netflix. Here's a chart of Netflix. Now, this was as of yesterday, so I've actually predated it back to the 21st. All right, and the earnings came out yesterday after the market closed. If you look at what Netflix has done, it's ran up from about 295 up to 340, pulled back up to 345, and we're sitting right here. And there were many, many people out there that were saying Netflix is going up to 360. There were a lot of people that were saying it's going to break 325 and break down to 320 below the support level. All right, and then there were a couple of option traders that said, hey, it doesn't matter if it does one or the other. Let's just buy both ways and hang on for the ride. So let's go look at each of those folks for just a moment. In that segment I call "Who Lost the Most." So to do that, we're going to go to an option table for Netflix. Again, yesterday's date. Now we're looking at closing prices. That's the best I can do when I go back and back test. And we have back testable data that goes back for years. All right, but we're going to look at just yesterday. So here's Netflix. I'm going to look at the Jan 24 options as of yesterday, and if I scroll down, stock closed at 338.11. The call options, so the 340 calls and 340 puts are really those or the 337s are really those ones that are at the money. I mean, we could take the 337 halves because they're going to be probably the closest. So if I bought the 337 half call, what's that going to look like? Let's click on risk graph. Here's my call option for 337.5. It's going to cost me $1,490 for one option contract. All right. Here's where we are right now. By the way, that $14.90 call only has 3 days to expiration. That was as of yesterday. All right. We really would need Netflix to get above, if you see the break even, 352.40. It's going to be that break even at expiration. The most we stand to lose is what we put into the trade, and that's all well and good until you see what happens today. So I'm going to click on plus a day. I want to show you what happened with Netflix. Okay, so we lost most of our money. If you bet on Netflix going up, it actually ended up down $12.11 today. And so our $14.90 is now 86 by 95. Not a good way to start off your trading earnings. And I got to tell you, I mean, if you look, you might say, well, I don't know, a lot of people didn't do that. There was 5,766 contracts that just traded the day the earnings came out. All right, before that, if we back up, minus a day, 2,968 contracts of people that were buying or were trading in this particular option. All right, so what you might be thinking is, well, if the Bulls lost all the money, the Bears must have made it. Let's go find out. So going back again, I'm going to clear out the calls and let's just focus on the 337 half puts. I'm going to buy one of those. All right, so let's take a look at what that's going to cost me. That's going to cost me $1,388. All right, again, in this case, we have to go down and we have to really hit, there's a break even of 323.62. All right, where do we double at? Well, we really don't double until we get down into the low threes. But let's see how this did. Plus a day, we know Netflix went down already, and for any of you that know. Well, you know what? You still lost 11% on this particular option because, yes, even though Netflix went down, the volatility absolutely collapsed. That's this area, that's this red line right here. This is where it was trading right before earnings, and boom, all the air has come out of the gas and that come out of the balloon because, again, what was unknown yesterday has now become known, right? So we can't make money on it going up, and apparently we can't make money on it going down either. And I'm sure that all of you by now realize that if I went in and bought the straddle, which is the call and the put. All right, that's going to be a delta neutral trade, regardless of market direction. You're really gonna need this thing to get up and go. Well, we all know what happened. I'm just going to click on plus a day. Look at that straddle cost, $2,878. Now, a day later, it was worth, well, it was worth a lot less. It dropped $1,559. It dropped in half in one day. All right, so obviously trading earnings, and this actually happens more often than not, guys. Trading earnings will apparently, if you've learned anything just in the first 11 minutes of being here, then you should know that the riskiest way to play earnings is buying right before earnings, attempting to sell for a profit right after the earnings announcement. Most of the time that does not happen, okay? So in order to be a successful earnings trader, maybe you might be thinking, well, wait a minute, maybe I should be doing the opposite of this. And you can, but then you got to worry about this risk. So how about we show you a way that you can trade earnings with the least amount of risk as possible by spotting the opportunity. We're going to show you an earnings strategy tonight that does just that, has the least amount of risk. You know why? Because very, very few people, we'll call them the least amount of option traders, actually know how to trade this particular way. All right, you can use calls, you can use puts, you can use straddles. There are certain times that you want to use those, and of course, planning, executing, and managing them. That's the part where you have to physically pull the trigger and decide, all right, I'm going to follow these rules. I'm going to buy here, I'm going to sell there, and I'm going to manage the trade all the way through. So, without further ado, I want to bring on our guest instructor tonight, who does exactly this. All right, his name is Mike Wade. You guys all should know him very well. Mike, good evening.
Good evening, everybody. Hi, Tom. Hi, Jay.
How are you? I just turned the controls over to you.
Okay, great.
So
Let me.
we got a lot of people in here who were very excited about learning exactly what it is that you're doing, since I just show them what not to do.
Yeah, I was horrified, Tom. I was watching what you were doing, and I think my heart rate.
I know. I probably scared half of them out of the room.
But there's just so much that novice option traders don't know under the covers. And what we're going to do here in the next hour or so, or less 45 minutes maybe, is I want to show you something that's near and dear to my heart. And I was doing the math while you were speaking there, Tom. I actually started teaching at Optionetics in 2002. So if I'm doing the math right, that's 18 years of teaching. I hadn't thought about that for a long time, and I'm a little shocked, actually.
That's incredible.
Can you believe that, Tom? You met 18 years ago.
It's crazy.
Woo! It's happening.
It's a good span of your life, and mine.
Yeah. Yeah, I shared it with you, Tom. It has been a pleasure. It's absolutely been a joy to be part of this group, and I love teaching. And when I first started teaching in 2002, I think people can sense that I actually genuinely care about students, and I really want to make an impact and a contribution to people, particularly you guys and girls that have really stepped up and invested in your options education. And way back in 2002, I was always on the lookout for strategies that were really smart and sophisticated and could be used for the novice trader all the way to the advanced trader, a system that was simple, that was reliable, that was repeatable, that was high probability, and most importantly, a system that reduced risk to the greatest degree possible. And so what I'm going to share with you tonight is that system. It took me about a good 5 or so years to develop it, and I'm going to walk you through the details of it. And the outcome of this session tonight will be a new way to trade straddles, a safe way, a way that very few people even understand. And we have tremendous amounts of computer power behind us to maximize our probability, all the while allowing you to trade in a stress-free, low-risk fashion. We have a student that calls this the beauty rest strategy. He's taken the class a few times, and that's really what it's about. It's about giving you something that's easy, that's reliable, and can make an impact on your trading account, all the while leaving you stress-free. And that's what this is. So the most reliable, consistent, and pattern-generating market catalyst. Before I answer that question, and the answer is obvious, but before I give you the obvious answer, trading is all about finding patterns that repeat. Everything in trading is predicting the future based on patterns that are derived with data from the past. Moving averages are that, earnings announcements are that, which is the answer to the question. Implied volatility patterns, money clock, all of it. Money calendar is all about historic patterns and counting on them to repeat. So that's our edge. And the edge that I'm about to share with you is these patterns that are really reliable and consistent when it comes to earnings. So there's 5 of them I want to share with you. There's others, but these are the 5 that we've built our systems around that provide those things I mentioned before, the stress-free trading system that actually works. So this is the standard pattern. Tom covered this with Netflix. Most people trade these breakouts. They look for stocks that break out at earnings. Here's one on Abercrombie and Fitch. There's plenty of them out there that do this. And of course, you got to be able to find them, and I'll show you how to find them. I've got some, by the way, I've got a couple of, I'm calling them payouts for this month. A couple of trades I want to share with you. These are case studies for you to paper trade of examples of these trades that are coming up in the next couple of weeks. Actually, one of them is in a couple of days. So notice here on Abercrombie, it gaps at earnings. So this earnings period, it gapped up. Here it gapped down. There it gapped up. Right over here is a small gap down. I don't have it marked, but this stock tends to gap pretty big at earnings. So history would tell us that in the next earnings announcement, we could reasonably expect the stock to gap like Netflix, and we can place a straddle. If we do it correctly, place a straddle and actually make money over an earnings announcement with the gap. The straddle that Tom showed you is a typical straddle. It is absolutely the wrong way to do it. If you want to trade the breakouts, I'll show you how to do that in just a few minutes. Here's another pattern. This is my favorite pattern on the planet. There is nothing more reliable than an implied volatility pattern on stocks that gap at earnings. All right, so this is an implied volatility chart. And really what it measures is demand of the options at the money options on a particular stock. So notice this is Green Mountain Coffee, and we could put any chart up here. But on Green Mountain Coffee, what happens in the few days before earnings, maybe a week or so before earnings, you can see that the implied volatility spikes up. That means the demand spikes up right into the earnings announcement. Remember Netflix. So option traders come in and they'll buy calls or puts or straddles, waiting for a gap. They'll bet on the upside, bet on the downside, or try to put a straddle on and hope there's a big enough gap. And they'll pay a premium for the options, waiting to the last minute. So that demand increases the price of those options, and then the next day, right after the announcement, the news is out, the stock does whatever it's going to do, but the implied volatility will crush. All right, that will come right out of the option position, and any options that you own will be a lot cheaper than they were the day before the earnings announcement. All right, so that's called IV crush, and you got to watch it. So we're going to use this pattern. So this is the thing that kills most straddle traders or most people that trade over the earnings announcement, is they don't understand this. They never heard of it. And even if they did, they probably wouldn't know what to do with it. We're going to not only turn this in, avoid the risk of an IV crush, we're actually going to turn the tables, and I'm going to introduce to you my baby, which is I call it the surf the red wave. And we're going to put on a neutral, delta neutral trade, a straddle. And then later I'll show you how to go directional, but we'll start with a straddle. And this straddle will make money simply with the expense curve, the implied volatility rush in the options. All the while, you want the stock to move. Whether it moves or not, you're going to make money, hopefully. And then if it does move, you'll make even more money. So that's the pattern. I call it surf the red wave. This is pattern number 2. And I've got a couple other ways I'm going to show you how to make money on this one. All right, so that's it. This is the thing that most misunderstand. You will now understand it. We're going to turn this from a foe into a very good friend. All right. And now here's another sort of offshoot on this IV rush. There are some stocks that actually move into an earnings announcement in the same direction. This is Morgan Stanley. This is a recent chart. And notice what Morgan Stanley does in the handful of days before an earnings announcement. It goes up. Additionally, not shown here, what happens is that the implied volatility rushes up as well. So similar, let's go back to this one. Similar to this chart, we've got a stock that actually goes directional, goes up into the earnings announcement, up into the earnings announcement, up. into the earnings announcement, up into the earnings announcement. So we get IV rush and we get directional moves. And this is the third pattern I want to talk about tonight. This is consistent directional moves into the earnings announcement and a rush of implied volatility. Both of these setups were out before the earnings announcement. All right, so we're going to ride the red wave into the announcement with a straddle or a call or a put, depending on the direction, the consistent direction into earnings. And we're going to make money two ways on both of these setups. Now, the thing is about these directional moves is that they'll make a lot more money than the straddles will make into the earnings announcement, because you're not carrying along a losing put or a call. So this makes more money. It's more risky, but you make a lot more money on these directional moves. So we're going to talk about those tonight. Another one that we just added last year in 2019 is this idea of gamma scalping. So there are some stocks that move around like bucking broncos between earnings announcements. Look at this one on Tesla. Look what it does. It's all over the map between earnings periods. And what we can do with straddles is to actually put on straddles right after the earnings announcement. And then as the stock moves big one way or the other, we can squeeze out risk and lock in profit by using delta neutral adjustments. It's an advanced strategy. It takes more work, but for some of our students, they really like the ability to always have an earnings related trade on. And gamma scalping, trading volatility between earnings, our fourth pattern, is a way to do that. And we've got a handful of traders that really love it. And I'm not going to do too much with that tonight. It is an advanced idea, but it is another way that you can trade these earnings patterns. And here's the other one. Again, back to the implied volatility chart. This is Walt Disney. Of all companies, Walt Disney actually has these big IV rushes into earnings announcements. Now, why is that? Well, the people love the options. They're expecting things to happen at earnings, although the stock really doesn't move at earnings. All right, so let me show you and distinguish the most highly probable pattern. I want to say 100. It is 100. I've never not seen this work. All right, so I'm going to say it's 100%. When the implied volatility spikes up into the earnings announcement, it does it there and it does it there. Again, we know that after the earnings announcement is over, the news is out, the implied volatility, demand for the options crushes the next day. All right, that pattern, those crushes are imminent. They will happen the next day. So what we could do is figure out a way to sell premium the day before the announcement, have the option premium. So we're selling expensive options the day before the announcement, and then the day after the announcement, the options become really cheap. So we sell something expensive in one day, and then less than, well, gosh, a couple hours later, well, overnight. So let's call it 8, 9, 10 hours later, whatever that is. We're buying that position back for a lot less. That position might be an iron condor. Notice what happens on Walt Disney. Iron condor, one day iron condor there. That's 100%. That's somewhere in the neighborhood of a 40, 50% profit overnight. 40 or 50% profit overnight. The stock doesn't move. So these iron condors expire close to worthless. Happens again there. So Disney is another pattern that we like. It's the pattern where the IV rushes in before the earnings announcement, the IV crushes after, but the stock doesn't move. Usually the stock will move, but there are some stocks, if you can find them, that actually don't. And so this is like really fast money, overnight profits. I still sell credit spreads, but there was a time when I came to Optionetics back in 2001, when I started as a student, I was a naked put seller. And then I joined Optionetics and I became a credit spread seller because I got my butt kicked in 2000 and I learned that selling naked puts was super risky. And so I stopped doing that. But I've been a seller, and I love selling premium. I love selling expensive options, particularly if I can take the trade off and buy them back for a lot cheaper in just a handful of days. In this case, it's a one-day trade. So that's another pattern, our fifth pattern, 5 ways to trade earnings in a really, really smart way. So let's distinguish just a little bit more about the power of implied volatility. Most don't understand it. And because of that, most would say to you that trading over an earnings announcement doesn't work. Most don't understand that they could actually make money with IV rushing into the earnings announcement. So the few who understand it can generate a great deal of profit from it. Fortunately, I understand it. So does Tom, so does Jay, so does many of our students. And I want to sort of break this down and make sure you understand how this works. So again, this is Green Mountain Coffee. And these IV spikes happen each and every earnings pattern, earnings announcement. And you can go back years, a handful of years, and you're going to see this pattern just consistent. It's consistently popping up like a heartbeat pattern. All right, so these patterns are common. Amazon does it. SanDisk. And I could go on and on. You understand the pattern. Again, why it happens. Option traders come in. They want to buy the options before the announcement, anticipating a move. And they pay a premium for the options right into the last moment before the announcement. And then the day after the announcement, the IV comes rushing out, whooshing out, and the options that were expensive here are now cheap there overnight. All right, so we want to get smart about how to play this. So the secret sauce in the way we handle earnings is really getting smart and harnessing the power of IV rush and even turning crush into a profitable proposition. And so how do we do that? We do that with scanners. And you know, all of you have used Platinum in the past, and a lot of you are using Tom's option tools now. It's the same root software. These scanners are like none in the industry. I've never seen anything like them. And these scanners, we have new scans that we've written over the last 4 or 5 years. And even we updated the scanners just last year. And these scanners really go out and do the work. They crunch millions of bytes of data and look at history and determine optimal entry points to maximize profits with 100% historical accuracy. Being able to get into these trades and hop in at a certain point and profit as options that are relatively expensive become more expensive, and do that without any directional risk. All right, so that's what we're up to. These powerful scanners will actually harness IV rush and give us the ability to make money on IV rush. Now, here's the best part. Now, whether you're trading a straddle into earnings or you're trading a call that historically, on a stock that historically moves up into earnings, or vice versa with a put, the thing about this IV rush is that it mitigates and it reduces your risk in the event you're wrong about the stock. All right, so this IV rush is going to keep your losses smaller than they would be without it. Trading into an earnings announcement with the right type of options, you can just make money on IV rush. The stock doesn't even have to move in a particular direction. All right, so this IV rush is the beauty, where the beauty rest comes in. This IV rush can make you money, and even if it doesn't, it will greatly mitigate and reduce the size of your losses. I love, it's like trading with a net, or what's the word? Trapeze, high flying trapeze with a net. Trading with a net. You're just not going to get hurt. You can't. This IV rush is going to really protect you from suffering any large losses. So that's the very best part. And as somebody who really wants to see people be successful in trading, this is the reason this is my favorite strategy to teach, because anybody can do it. And the number one thing is you will make money with these strategies, but number one, you're just not going to lose much when you're wrong. And that allows you to really sleep well at night and to trade in a way where you can be at peace. It's easy to build confidence. You're going to be calm. You'll sleep well at night. So I love it. This is the reason that I'm teaching this class. All right, let's start with my baby. I call it surfing the red wave. And what this is all about is about riding that red IV wave into the earnings announcement. All right. Now we can do it in one of two ways. We can do it with a straddle, which is what I'm going to start with. A short-term straddle, we're going to put a straddle on at a particular time before the earnings announcement. Now, there's an optimal time, and I'm going to tell you how I found that in just a second, but the thing to consider is we're going to be trading short-term options so that we can maximize the impact of IV rush. IV rush is more in the shorter-term options, so we want to buy the shortest term possible to capture as much IV rush as possible, and that means more profit as possible. The thing we contend with, though, is time decay. This thing called theta is going to start working against us the longer we stay in the trade. So we want to get in and get out at an optimal point. So we don't want to stay in there for too long. We want to get in and get out and get the maximum profit. So these scanners that we have now that have taken years to develop, what was it, about 5, 6, 7 years ago, I think 6 years ago is when I worked with John with the tools, and we built the scanner over about a year, and we've refined it since then. But you got to figure out when to get in. So in this case on Green Mountain, we might get in there and then out at the earnings announcement. We might get in sooner on the next earnings announcement and then out at the earnings announcement. And then maybe on the third earnings announcement, we get in later, closer to the earnings announcement, and then out at the top. And then again, maybe it's sooner in the last earnings announcement. So the point is, you got to know where to optimize and pick the proper number of days before the earnings announcement. And fortunately, the scanners will do that for us. You don't have to worry about it. So let's take a look at an example. So this is all the examples I'm sharing with you tonight are examples that I've published. So these have been published. The results were derived by a third party and done transparently. So this was not a back test. This was not like a sample. These were published trades that students actually took and played with in whatever way they chose to play with them. All right, so this is on Corning. Now, Corning, you might not expect Corning, it's a Dow stock, you might not expect Corning to be a stock that attracts attention at earnings, but surprisingly, it does. I mean, if you look at these last two earnings periods, Corning gapped here down, and it gapped up in the earnings period prior to that, and it tends to do it. And notice that the implied volatility for both those earnings announcements actually spiked up. All right. So with earnings in 14 days, I'm back tested to 10/15 of last year, October 15 of 2019. We knew earnings was coming up in 14 days, and our scanners said, get in 14 days before if you wish to maximize your probability of profit and maximize your actual return on investment. That was the optimal day, and that's why we got in. The scanner told me that 100% of the time, if you get in 14 days before the earnings announcement, this trade will make money. So this is the trade we put on. It is a straddle. It's a 17-day straddle. Notice here the number of days. We're buying a November 1. Remember, it's October the 15th. November 1, 29.50 call, and then a 29.50 put. That's a straddle at 29.50. We spent $1.94 per contract, $194 for the shares controlled. We did 10 of them, risking $2,000. So note one, just side note here, to trade these things, because we're using weekly options, these options will have just a few days left in them when the earnings happens. But note this, it's very common for us to spend, less than $200 on one straddle. So you don't have to have a lot of money to trade these things. They're actually quite cheap. Some of them are more expensive, but it's very common to get into these things for $200 or so a contract. So it is a nice strategy for novices for a lot of reasons, and that's another one of them. All right, so this was the trade, and there's our straddle. We're expecting the implied volatility to rush. Now let's quickly look at the risk graph. We didn't look at these. You might not have seen a risk graph for a straddle in a while. Just to briefly outline it, we have our break-even line right here, this vertical black line, and losses to the left, and profit is to the right. 1,000, 2,000, 3,000 profit. Then we have our current price of the stock, which is this horizontal blue line, and then you can see the stock price on the vertical axis. So notice here that if the stock rises today, what's going to happen is I'm going to make money. So if the stock, for example, went up to 31.65, we'd make $752 of profit. That might be hard to see on your screens, but that's what it says. All right, so this red line is the actual risk graph of the straddle today. And you can see here the number of days corresponding to the a particular color. So at expiration, which is the black line, and 0 days left, you'll see that we have this angular line. Looks like a witch's hat. So that's your maximum loss or profit potential. So that's the expiration line, and then we break it down into thirds. So 12 days and 6 days are blue and green. So what happens typically over time is that as we go from 17 days to 12 days to 6 days to expiration, these colored lines will start to sink towards loss. That's typically what happens with a straddle, and that is really critical. Let's make sure you got that. As time passes, these colored lines collapse into loss. Normally, let me show you what happened. When it was time to get out, it was 10/28. This was the day before earnings. Earnings was on 10/29 before market open. That's in the morning, so we get out the night before. We don't have any time to mess around with IV crush. We're going to get in and get out before the actual announcement, like scalping tickets for the Super Bowl. We're doing it with earnings, with implied volatility. So notice what happened. First off, in about 14 days or so, we made 25% return on our money. All right, that's good. For 2 weeks, that's for 14 days. That's actually really good. Notice what happened. The stock actually rose, but that's not the best part. The best part, stay with me here. Watch this. This is the sleep at night part of this strategy. Had the stock stayed where it was, right around 29.50, where it started, we still would have made money. Look at these colored lines. What happened to them? They got pushed into profit. There is no way that this trade would have lost money anywhere, no matter where the stock was, because this red line is the current profit in the trade. There is no place where that red line extends to the left of this break even. So it's all of it's in profit. Why is that? These lines literally got pushed into profit. The stock movement gave us a little bit of extra profit. Even if the stock hadn't moved up, we still would have made $280 on this trade. Why is that? Well, look, this is the implied volatility rush. Okay, so that's, I just think this is the most sexy way to make money on the planet. Not very few people understand how to do this, but we got in here when the implied volatility was down here, and then it rushed up here so much that it offset time decay and put a trade in a guaranteed profit position before the earnings announcement. All right, so we got out, we made 25%. We did it while sleeping at night with very, very low risk at all in this trade. So even if the stock doesn't move and the IV doesn't rush as much, it still will rush, and it will offset any risk that you would normally get. So basically, your risk is a lot less in the event the stock doesn't move and the IV doesn't rush as much as anticipated. So that's a beautiful thing. Now let me show you one thing. I haven't even looked at this, but let's take this forward 1 day. So the day after the earnings announcement. So notice what would have happened. So I went to the 29th. So the earnings happened. What happened to the stock? It didn't do that much. Stock didn't do that much. Actually kind of ended up just a little bit lower. But look what happened to the implied volatility rush. Those people that traded Netflix after the earnings announcement experienced something very much like this. We didn't, because we didn't hold over the earnings announcement. We got in, we took our money, and we got out before the announcement. So we snuck in, took our money, and left before the action happened. All right, so there's the beauty of this strategy. Now, what I'm going to cover from here are some derivations and some things that we can add on top of it. But really, I could stop right now and say this is really the meat. This is what you want in your trading arsenal. Whether you use straddles, whether you use calls or puts, any kind of strategy that's running into an earnings announcement where this happens, You gotta position yourself in some way to make money on that. Okay, let me show you another red wave example. This is on Tom. This is Tom. Let me show you. That's funny, Tom. Let me show you the right way to trade Xilinx. This was a while ago, and we trade Xilinx a lot in my classes because it works almost all the time. And we got into Xilinx, and we got into this trade 8 days before the earnings announcement. And in the same fashion that we did with Corning, we bought a straddle. Which straddle did we buy? We bought a Jan 25 91 straddle. Had 10 days of time in the straddle, and the earnings announcement was in 8 days. So upon the announcement, we'd have a weekly option that only had 2 days of time left in it. All right, that's a terrible thing to do unless you're very sure that implied volatility will rush in, and we knew that Netflix would normally do that. Okay, so let's take it to 3 days later. Look what happened just 3 days later. We had 18% return that popped in 3 days later. And look at that. The reason why what happened, IV rushed in. IV rushed in enough, pushed the colored lines into profit. There was profit even if the stock hadn't moved. We got a little icing on the cake here. The stock moved up, and that left us with even more profit. All right, so there's another example. They're all over the place if you know where to find them. Not everybody can find them. We can with our scanners. Now, we chose to adjust this one and move the apex of the straddle to this point so that we could preserve some of this profit up here, this $384 of profit, with a delta neutral adjustment, which you'll learn in my class if you choose to join us, with a delta neutral adjustment, which was on 118. Let's take a look at that. So what we did was we reduced our risk a lot. Our risk was $2,040, and the stock was sort of up here. We're expecting it to hit resistance and drop, and we actually adjusted this live before the event and published it. And then this was the new adjustment where we moved the straddle up, locked in some profit, and you can see here that our risk dropped about $400 and some on that adjustment. So we're actually able to squeeze out risk with delta neutral adjustments. And then this whole thing ended up in a beautiful profit in just 8 days. We ended up with 53% profit on this trade in 8 days. That's pretty normal. That's within striking distance. Normally the returns are in the 30 to 50% range, and the losses are in the 10 to 15% range. So, and we win more than we lose. So there's an example of the power of this system, and it's at the heart of it. So that's the heart of what we're up to. And that doesn't mean that we don't play breakouts. So I want to show you breakouts really quickly, give you an example. Now, the trick with breakouts is to find historically stocks that break out enough and consistently enough to actually generate profits. So the thing to contend with on these breakouts is implied volatility crush. Okay, so let me take you back here. So if you place a breakout, let's say I'm looking at this stock here and I want to place a breakout, and I want to place a straddle, and I place a straddle over here somewhere, and I'm buying expensive options, and then the stock does what it does. Let's say it does break out, but I've got to worry about the impact of implied volatility crush. So there's ways to navigate that by buying early, like 30 days before. But with the scanners we've got now, actually detect historically an optimal time to get in. It's usually less than 30 days, maybe 16 days, 15 days, 21 days, 10 days even. And it tells you that historically, if you get in a certain number of days before the announcement, the breakouts happen to such an extent that you actually tend to make money on the breakouts. So one of them that I actually published was this one on Lowe's, and we got into Lowe's actually 16 days before the earnings announcement. And we want, and this one it's not the red wave. We're actually intending to hold over the breakout so that we can generate some profits. The reason we want to do that is because these breakouts, when they really break out, have profits that far exceed, I can't say far exceed, sometimes they do, but they're bigger usually than the profits on a red wave, because red waves are so much safer. These carry a bit more risk. So we've mitigated the risk with historical data, with historical scanning, and we placed this straddle. We published it. This was a June 21 110 straddle. We spent $875 contract. We did 2 of them to get us close to 2,000. And let's see, we got in on the May the 6th, and then May 21 was the day before the announcement. And you can see here, the day before the announcement, the time decay had come out of the position. So we were down a little bit. The implied volatility rushed up, but isn't really getting that hot. And then the next day, which was the earnings on the 22nd before market, the stock gapped, and it gapped down enough sufficiently that generated a 40% profit, $698 profit on a trade over a 16-day time frame. So breakouts do work. And what I like to do is mix the two. I like and prefer the safer red wave trades, riding the red wave into the earnings announcement and getting out before it gets hot. And then there are some cases where history tells us it's a really good idea to play these breakouts as well. So we do a 1-2 punch on the straddles. This is a performance that we've gotten over the last 3.5 years. And these are all published trades. You notice that we've made $21,000. The average position size was somewhere in the neighborhood of $1,700. We had a 52% win rate over that period of time. And the average win was twice the size, roughly twice the size of the average loss. Okay, so now is a 52% win rate good? Yeah, it's fine, particularly if your winners are about twice the size of your losers. Okay, so remember, now I could have a 60% win rate or a 70% win rate, but normally when you do that, your average gain to average loss ratio actually is nowhere near as good. You might get a 1.5 to 1 or something like that. So remember, this is a beauty rest system. You can sleep at night. You just aren't going to get killed on any of your trades with this strategy. And if that's of interest to you, 52% win rate is plenty. $21,000 obviously is a lot of money in 3.5 years. And your average gain to loss ratio is exceptional. Now, as Emeril Lagasse would say, let's kick it up a notch. Bam! I actually saw him on TV last week, guys. I hadn't seen him in a while. I used to like watching his show. I think he's a cool dude. Now, let's increase the size of our profits. How do we do that? Let's find stocks that move in a particular direction consistently before earnings. And we're going to use the same technology that's going to go out and find these stocks that do it and tell us exactly the number of days to get in. These trades will make money on direction. These trades will make money on implied volatility rush. We're going to get in before the earnings announcement, and we're going to get out after the earnings announcement. I guarantee you, Tom, had you done one of these directional calls or on Netflix, you would have made money into the earnings announcement. I believe it went up into the last earnings announcement, if I remember correctly, but it tends to. So this is what we're talking about. Let's take a look at an example. This is an example on Goldman Sachs that I just did on January the 7th. What was that, a couple of weeks ago? Not even. And these are the stats that come back. This is a stock that 100% of the time, over the last 4 earnings periods, getting in 8 days before the earnings announcement generates an average of 76.77% return on investment, 69, 98, 95, and 45% return specifically over the last 4 earnings periods. What do you think the chances of this happening at the next earnings announcement? I would say really high. The software, the scanners tell us when to get in, and they tell us when to get out. How simple can it be? It also tells us, I haven't got it shown here, but it also tells us exactly which option to buy. This is what the stock, Goldman Sachs, had done over the last 4 earnings periods. And I don't have the current one shown, but it also went up. You can see that consistently Goldman Sachs rises very nicely into the earnings announcement, 8 days before the announcement. Let me show you the trade we actually put on Goldman Sachs. Now this is for all intents and purposes exactly the same as the red wave trade. The only difference is we're trading directionally with a long call, because the stock goes up consistently into earnings, and we're expecting that history to repeat. And when it does repeat, as you'll see, the amount of money you make on these things can really get your attention. So we bought a 237.50 call for $3.43. This was a 10-day option. This was a weekly option that would expire in 10 days, and we're going to hold it for 8 days and get out on the 14th, which is one day, the last trading day before market on the 15th, which is when the earnings would come out. So let's advance this to 114, and let's see what it did. How about 174% return on investment in 8 days, while only risking $343? A $600 return on investment in just 8 days. You can see the stock actually gapped up into the earnings announcement. And what else happened? So we made money on stock price movement, and we also made money on implied volatility rush. Ladies and gentlemen, you must put the wins of implied volatility rush at your backs when you're trading directionally or non-directionally. You just got to do it. You must do this for yourselves. It helps your profits, magnifies your profits, and it reduces your loss. I'm hard pressed to trade directionally unless I've got IV rush coming in as wind behind my back. So that is the optional. Oh, I'm sorry. This is actually what happened with Goldman Sachs. I forgot I had this slide in here. You can see that Goldman Sachs actually had a nice little run up to about 245 and generated that 179% profit in a mere 8 days. Now, when you add, this is January's performance so far, having just kicked it up a notch with directional optimal, we call it optimal call put. Let's call it directional red waves. We call it that too. The system is up this month so far. We've generated some profit. We're at 60% win rate. And our ad, now this is what I wanted to accomplish with directional earnings trades, these directional red waves. And notice here that the average gain to loss ratio has increased quite dramatically. It's almost 3 to 1, very close to just under 3 to 1. So we have increased the average gain by about 30% over just the red waves and the breakouts. So to me, this is a perfect cocktail of high probability, low risk returns that we're very excited about, and we are looking forward to passing this technology along to whoever wants to grab it. The timing is right. Earnings is really about to start kicking in this week and next. It's starting to happen, so the timing is right. We're going to start a class next Tuesday, and we're going to get in and we're going to harness the power of this great technology and make a difference for people. These are some real examples that I've done over the last year or so, and I could go through all of them. I'll make a couple of points. You can see that I've got breakouts, red waves, in what I call optimal call puts, or directional red waves, you call them that. And you'll see some things, some behaviors. Breakouts tend to have higher returns on investments than red waves, but red waves will have lower risks. All right, so we get the big wins here and slightly bigger losses. And here we get slightly slightly smaller wins, but still good wins, but our losses are mitigated very much in the red waves. And then on the optimal call put, our probabilities are high and our profits eclipse everything else. And the best news on the board is even that strategy that can generate 175% return. That same strategy, when you're wrong, is typically going to lose just a little bit. All right, so again, that IV rush, that secret sauce, is really mitigating and greatly reducing our risk in anything we trade into the earnings announcement. All right, I've got some toys for you. These are little presents I want you to play with, and I would recommend that you paper trade these. But I've got a red wave straddle, and I've got an optimal call, or let's call it a red wave. I'm going to change the name of it. I'm going to call it a red wave call. And here it is. This is on a company called Blackline, NASDAQ symbol BL. And this is a red wave straddle. 100% of the time over the last 4 earnings periods, this placing a straddle, a short-term straddle, has generated an average of 40% return. The entry date is shown here. and the exit date there. Get in on the 3rd, get out on the 13th. Here's what the risk graph will look like. This is what it currently looks like. Now, you want to buy an at the money straddle, a February 21 straddle. And I'm not going to give you the strike prices because I don't know what they're going to be yet, because the entry date is not today. Here's the entry date on February the 3rd. So we've got to wait a couple of weeks. But on February the 3rd, you want to buy to open the black line February 21 at the money straddle. So you find the strike prices that are closest to the current price of the stock. You buy a call, a February 21 call, and then you buy a February 21 put. Same strike price. That will be your straddle. And then on the 13th, during the last market hour of the day, you want to sell that same straddle that you bought. Simple. Buy it during the last hour of the market day on the 3rd, sell it in the last hour of the market day on the 13th. It gets no simpler than that, I got to say. All right, here's our optimal call. This is our red wave call. Similar, 100% of the time. And this is on General Dynamics. I love General Dynamics. And this one is coming up in 2 days. So this is what? This would be Friday, a Friday trade. So this is coming up soon. And on General Dynamics, what you want to do is buy a call option on the 24th and sell it 5 days later on the 28th. All right, 100% of the time over the last 4 earnings periods, buying a call in this fashion has generated a 94.76. What? A 94% return in 5 days? Yeah. Why is that? Stock goes up consistently, IV rushes consistently. The two together can produce magnificent profits. Over the last 4 earnings periods, 114%, 31%, 153%, and 81% returns. History tends to repeat. And I think, obviously we have a very high probability of making a good bit of money on General Dynamics. Of course, it may not make money, there's no guarantees, but it doesn't get much better than this, I gotta say. All right, so here's the actual trade. So you want to, on January 24th, which is Friday, during the last hour of the day, you can do it in the second half of the day. Tend to like to do these at the end, but you want to buy a General Dynamics. This is a GD as a symbol, January 31 at the money call. All right. I don't know what that's going to be yet, but just pick a call that's at the money, maybe 1 strike out of the money, and then sell that same call on January the 28th during the last hour of the market day. History repeats. You could reasonably expect somewhere in the neighborhood of 94%. If history repeats, even if it does what it did 2 earnings periods ago, you're still going to make 31%. If history repeats, that's really the key to note there. History doesn't always repeat. Now, these are some of the trades I'm looking at for the upcoming season, and all of these are coming up. We got Oracle and Discovery, Anthem. Notice the returns on investment here: 156%, 79, 54, 52. You can see there. You can read as well as I can speak it, but you can see that the returns are great. We've got these setups ready to go. I'm gonna teach you how to find these things, but I'll share them with you. These are all coming up. Yeah.
I might want to add too that these are all not just calls. There's puts in here, there's straddles in here, there's a mix in here. So
That's correct.
This is something you're going to be teaching starting next week.
Mm-hmm. Exactly. You'll have these. We'll be talking about these on Tuesday. But these are all. There's a couple of directional red waves in here. There's red wave trades and there's breakout trades as well. So Tom, I think it's a good time, or Jay, I think it's a good time to take a few questions, and then I'll talk a little bit about the curriculum, and then I'll pass it over to Tom so he can talk about how to jump in with this system. Jay?
What I'm seeing here, and Tom already answered this for Carrie, but I think everybody should hear this. She was just confirming that the profit and loss summary that you gave was assuming holding until the recommended exit. And Tom says, and we back it up, that yes, it was. It's on the entry and the exit dates given. That's what the summary is showing there, correct?
That's correct.
Okay.
That is correct.
And I might add too that, this is just, everybody's different as a trader. I mean, it doesn't matter who you are, we're all going to get a little bit of if we all traded the same thing on the same day, we'd all still get some sort of a variance in terms of fills. That's just the way it is. I typically like to get into these trades. I don't like to get in at the open, and I don't like to get in at the close. I like to get in somewhere in the middle, because that's when, typically your volatility is much like volume. There's a spike at the beginning of the day, there's a spike at the end of the day. So
Right.
I like to enter my earnings trades somewhere in the middle of the day, but I love getting out of them right before like the last half hour of the day, Mike. That's what I do. I was doing it today. I had 3 winners today that I got out of. One was a fantastic trade, but they're all based on the exact stuff that you're talking about in here. But I typically, that 3:30 to 4 o'clock, that's the time when I start ringing the bell myself.
Me too. That's all the last minute shoppers coming in, Tom.
Exactly. Yeah, they're all getting ready right before the close, so they can be positioned to, I want to sell them on the dream. The problem is they're living the nightmare, not me. I mean,
I like
I'll say the same thing too, Mike. I don't win 100% of the time. I mean, my win rate is it's not the win rate. It's the overall, the fact that this rinse and repeat strategy just will slowly build your account up. I mean, if I were to I'm going to throw a number out here right now. I'm just let me see where I've been just in the last week. I'm about 7% on my account just in the last week, the one that I do strictly earnings trades on. So in the last week, 7%. That's not bad.
Do that every week. What do you got?
Yeah. I wish we had these kind of weeks 52 weeks a year. Unfortunately, earnings is a season that happens once a quarter, and you get that swelling effect that happens over about one good month. It's a feast or famine. That's what this particular strategy is. We want to be in when we're feasting, and when it's a famine, you'll get trades here or there. You just don't get them like we're getting right now and what we're about to get.
Yeah, we get trades every month, and then we have the gamma straddles that we just added this year. And if you're inclined, you can trade those. And we always have directional trades going on as well. So, but you're right. Every 3 months, starting in January, end of January, there's a concentration. But we have trades every month with this system.
And Deborah has a great question. She's talking about if you want to take the series, then do you have to do trades every earnings season, or do you have to join every earnings season? You don't have to join every earnings season, Deborah. This is you learn it, and then it's there. It presents itself for you. And what I think we ought to do, Mike, is why don't you right now go through the curriculum a little bit and talk about and show the buttons too that we have, and I'll talk about what we're doing for the Optionetics students tonight.
Beautiful. That sounds good. And just really quickly, I wanted to add to what you just said, that last question. Once you take the class is 6 weeks, but you have access you have access to my board, and my board is mostly about straddles and these strategies. So you'll have continual support and community around you if you choose to go down this road. So we're going to talk about a lot of stuff. We've got 6 weeks together, and we've got a lot to talk about. I want to get into the basics and deconstruct strangle spreads, understanding them, getting to the Greeks. Greeks are no big deal. I'll demystify them. You'll understand how you can use them to really understand straddles. We're going to get into IV rush, how to profit before earnings. We're going to surf the red wave. We're going to do pre-directional. We're going to do breakouts. We're going to avoid impact of IV crush. We're going to determine optimal entry and exit dates. Now, I haven't talked too much about these, but we're also going to get into gamma straddles, which capture profits between earnings. So we have a wire-to-wire opportunities to make money with straddles. I also want to highlight making money overnight using these 24-hour iron condors. We're going to get into delta neutral adjustments. I mentioned that just briefly in tonight's example on Xilinx. Actually, yeah, that was Xilinx, right? And then how to use confirmation techniques to maximize your probability and reduce your risk. Lots of live case studies and back testing. We have a discussion board where you can share. Here's the buttons that you're going to get, and there's a great deal of technology and years of development behind some of these. We have buttons that will actually find the heartbeat patterns, these red wave and even black wave, longer term IV rush, explosive IV rush patterns. We have optimal straddle, which goes out and finds the optimal day to enter short-term straddles to surf the red wave and survive IV or survive theta decay. All right, so I showed you a couple of examples on that, Xilinx and Corning. We have a breakout straddle finder that finds the optimal data into breakout straddles that make more money when they're right and that also survive IV crush. We've got an optimal call put button, and this is really the directional surf the red wave button. So it does the same thing as straddles, except it does it directionally. It finds stocks for you that move consistently up or consistently down into earnings. Now think about that. It finds those for you. There's thousands of stocks that have options and earnings, and this will go out and scan all of them and find the ones that move consistently up or down at least 4 earnings periods, 4 periods into earnings. And then we have Gamma Trapper, which is the ability to do gamma scalping between earnings announcements. What is gamma scalping? Essentially, it's adjusting straddles, delta neutralizing them as the stock moves to squeeze out risk and to lock in profit. It's a really smart way to harness movement in stocks and generate good profits, consistent profits. 24-hour earnings is finding the highest probability 24-hour iron condors. So there's a lot there. So this button will be made available to you in this class. It's all included. And every week, we're going to get into more and more detail on each of these buttons. So by the time we're done in 6 weeks, you will know each of these buttons cold, and you'll be able to harness the power and utilize the secret sauce I've been talking about tonight. So people like this course. I've been teaching it for, this will be my 4th year, I think. Yeah, 4 years. And I get students that take it over and over. I've had a handful of students that have taken it each time. My favorite comment, I've used this one since this was 3 years ago. One of our students said, I call this my beauty rest strategy. I can sleep well no matter what the market is doing. And that's the case. If you traded any other, pretty much any other strategy, there's always the possibility that you wake up in the morning and the stock has gapped the wrong way and you're hurting. All right, that just doesn't happen, certainly with straddles. So, you know, if you're trading red wave straddles in particular, you're just not going to get hurt. The best thing that could happen on surprises is that is the worst thing that could happen on surprise moves is that you'll make money. Another advantage of this, another student says, another advantage of this strategy is that it does not require one to be in front of the computer daily, and you can set up automatic exits based on profit targets. So these entries and exits can be automated. You can be at work and have these things kick off automatically. You don't even have to watch. All right. So it's essentially a set and forget strategy. Somebody cracked a joke, said, can we get the SEC to require earnings every 2 months? I would love that, believe me. And of course, if that happened, we'd have a lot more opportunities. So a bit of a joke, but straddles are traditionally thought of as expensive. They're not expensive. Purchasing calls and puts can be expensive, but because we're using short-term options, we can get into, you know, as I showed you, an example of a straddle that was $200, less than $200. So you don't need a big account to trade these things, and you can trade these things with a big account. And then the last comment that we have, we've got plenty of other comments, but this is one that I wanted to throw out. If you can win 2 out of 3 and outpace your winners outpacing your losers 3 to 1 or even 2 to 1, then what other strategy would you rather be doing? So Tom, I'm excited. I love this class. It's my favorite time of the year, and I'm excited. I'm here for any questions, but I'm going to pass it over to you, and you can share with them how they can join me next week. Hello, Tom.
That's awesome, Mike. Thank you very much. I am going to grab the mic or the controls back from you, because what I want to do is I want to show people where they can go to get this, because I'm already getting people asking, well, where can I go to get this offer? So we offer this as tomgentile.com/20earning, and this isn't something you're going to find on Google. This you can't just go out there and find this. This is something that is invitation only. I put it in the handout, or excuse me, in the chat box. I'll put it in there again. We already have people that are signing up for this right now, Mike. But if you were to click on this link I just sent everyone in the chat box, in fact, you know what I'll do? I'll pop it into a Q&A. Let's see. Let me do it right here and send this to everybody. So you're either going to get it through the question or you're going to get it through the chat. If you click on that, you'll come to the exact same page I'm at right now, which is our Earnings Mastery Series with Mike Wade. So we're doing a special offer for our Optionetics students. And this package is regularly priced at $37.95. Now, the reason why is because we're adding something else to it. So you get like we said, you got the recordings, online classes. There's 6. Those are 90 to 120-minute live online classes with Mike. We will start them on Tuesday, January 28th. They are 8 p.m. to 9:30 or 10. The recordings go out immediately afterwards. You'll get 12 months of access to the recorded sessions. There's live case studies, and there'll be quite a few. I think, Mike, you'll be going through every one of those members trades you showed just a few minutes ago.
Oh, yeah, absolutely, and more.
I thought so. And so you're also going to get the mastery scans. But we also know that those of you on the program tonight maybe have never tried our tools before, which is our upgrade from Platinum. So here's what I'm going to do. I'm going to add on 60 days of our Complete Trader tool package. All right, so our Complete Trader tool package, if I were to just jump in and show you what that looks like, let me go on in here. It's really the kitchen sink of everything we offer. And so over here at Complete Trader, so you get the Option Trader package, which is all of our option scans, 5 years plus of data. You get the darknet channels, which is a whole strategy in itself. And you can see, for instance, this is a darknet trade that we had right here that gave a buy signal today. The last couple buy signals, sell signals actually worked out very well. Here's NetEase. NetEase had a last buy signal was down here at 210. That exited way up here at 320. Another buy signal came in. As you can see, it sold today. This is based on channel collisions. The other thing you're going to get is you're going to get access to our money calendar. So our money calendar is basically something that I have a patent pending on right now, which takes millions of data bits and basically shows you, based on seasonality, the best day to be a buyer, the best day to be a seller at that particular time. So for instance, if I look at tonight, the 22nd, I can see immediately by ranking this by power meter, and we show you how to do that. Booking, Netflix, LMT, MCO, these are the best trades going forward right now on the bullish side. AGN is a bear right now for the next 10 trading days. VRTX is a bear for the next 15 days. What's that based on? That's based on the last 10 years, as you can see here, based on what we see for yearly trade results. And this is going for this year from January 22nd to March 3rd. That's booking.com. So you're going to get that entire thing, but you're also going to get access to the earnings mastery button, which Mike showed you. So that's something that comes along with that. All right, so earnings mastery. We also have a forum. So if you, for instance, you don't, most people don't know what to ask until the live class is over and you go, wow, I should have asked him that. Well, you're going to get an upgraded forum where you can talk directly with Mike Wade and your fellow earnings mastery students, where you can comment and ask Mike questions in between the classes. We also have live technical support through phone. All right. We also have that through Skype and through email. Phone and Skype are going to be during market hours. Email, obviously, you can email us 24 hours a day, and we'll get back to you as soon as possible. Like I said, a couple things that we're doing. In the past, we've made this a 5-week class. We've upgraded this to a 6-week class because we just have so much more that we need to make sure you understand. Second thing we're doing is we're adding in 60 days of that Complete Trader tool package. And by the way, for those of you asking, well, how much is it after that to maintain the scans? The scans are yours for as long as you maintain an active subscription with Tom's Option Tools, and the subscription starts as low as $79 a month, and that includes your scans, your earnings mastery scans. All right. Finally, we have a money back guarantee. So some of you are thinking this is a pretty cool strategy. I want to learn more about it. I don't know if it's for me. So here's what we're doing. If you do sign up and you're one of the first 25 people that sign up for this particular special, which by the way is a 45% off special, we're offering it tonight for $19.95, $1,995. If you sign up, you join us on January 28th. If you feel like after that it's not for you, you can't commit to it, then not a problem. Email us back before week 2 starts, and we will send you a full and instant refund. All right. This offer will expire either when we hit 25 people on this special tonight or within a week. We start in less than a week, so it's actually going to expire in less than a week. But if we hit the 25 folks, we are just going to shut it down. It's just going to be that simple. So, guys, there you go. If you want, like I said, more information on this, you can hit that link I just gave you. I will email you along with this broadcast. I'm going to email you the slide deck, so you'll have all of the slides that Mike Wade had discussed tonight, as well as links to this offer. And I can tell you right now, people are already signing up for it. So there's less than 25 spots available at this time. All right, Mike, any final comments?
No, I just, I love doing this. I look forward to spending time 6 weeks with all of you that decide to spend time with me. I just want you to know that I'm a stand for your success, and I would love to contribute to your trading success, and join us. You'll be glad you did.
I mean, no better way I know to have 6 weeks of over-the-shoulder trading with Mike and myself. Jay, are there any final questions or comments that you need to share with us?
No, gentlemen, you guys did a great job, and everybody seems satisfactorily answered. So thank you.
All right, awesome. Well, thank you guys for joining us tonight. Recording will be out shortly. And again, if you have any questions, you can email us, support@tomgentile.com. Again, that's support@tomgentile.com. Have a great night, and we'll talk to you soon. Bye now.